Look, I'm just gonna say it. If your retail price is wrong, nothing else matters. You could have the best product in the world, amazing branding, a killer pitch deck, but if your math doesn't work, you're either going to price yourself off the shelf or worse, you sell tons of units and still go broke. I've seen both happen and I have been dangerously close to both myself. So today we are breaking down the retail pricing from the ground up. Landed cost, distributor margin, retail margin, trade spend, all of it. Real number, real math, the stuff that nobody tells you until you're already bleeding money. Hi, I'm Gia. I'm the founder of Hapa Queen, a Sichuan-inspired food brand. We went from 0 to over 1,000 retail stores in 2 years. And I've launched multiple SKUs across different price points. Work with distributors, negotiate with buyers, and I've made pricing mistakes that cost me real money. So now this video is for you if you're in one of the two camps. One, you're a founder who tried to get your product into retail shops, whether it's Whole Foods, Target, or your local grocery chain, and you need to know how to price it so you actually make money. Two, maybe you're a content creator thinking about launching a physical product in the creator to consumer space. You want to sell directly to your audiences, but you're also thinking about retail down the line. Either way, you need to understand product pricing before you commit to a manufacturer. This video isn't theory, it's what I wish someone had explained to me before I email out my first price list. Alright, so retail price has really 3 layers. Think about it as a cake, except this cake is made of margins and everyone wants a slice. So layer number 1 is your landed cost. This is what actually costs you to get 1 unit of your product sitting in your warehouse ready to ship. Not just what the factory charges you, but everything. So including the FOB cost, which is the factory cost, packaging cost, freight, costumes, duties, trucking, warehouse receiving fees, all of it. This is your foundation. If you don't know this number, you can't price anything. Layer number 2 is distributor price. So most brands don't sell directly to retailers, they sell to a distributor like Unify or KeHE or a regional player, and they sell to the store. By the way, if you want to grasp the 5 key players that run the retail and understand the difference between a distributor, a broker, and a retailer, you should watch this video first. Okay, back to the distributors. So they typically take about 18 to 25% markup. So if the price of your product for the distributor is $1, then they will sell that product to a retailer for $1.18 or $1.25. That difference, that's their cut for aggregate invoices, warehousing, and sending your products to each retail store. Layer number 3 is the retailer pricing. So the retailer buys from the distributor and marks it up for the shelf. Standard grocery margin is roughly about 35 to 50% depending on the category, but 40% is pretty common. Be aware that the distributor takes 20% markup while retailer wants 40% margin. The calculation is slightly different. We'll get to that as example later. So if your product sells for, let's say, $10 on the shelf, then the retailer probably paid around $6, which is about 40% of $10. And then here's the thing. The retailer sets the final shelf price, not you. You can suggest an MSRP, which is manufacturer suggested retail price, but they don't have to follow it. Talk more on that in a minute. So let me show you how this works with a real example. Let's say that you want to make a fancy bag of roasted nuts, and then you want to sell it for $10 on the shelf. That's a price of a customer would buy at a grocery store. So start at the shelf and let's work backwards. So the retail price is at $10. And then the retailer wants a 40% margin, so then they're going to pay $6. Now, you're probably not selling directly to that retailer, you're selling to a distributor. The distributor takes about 20% markup. So if the retailer pays $6, the distributor pays you $5. And that $5, that is your revenue per unit. And that's what hits your bank account. But wait, you still have costs. Let's say that your landed cost, meaning factory, freight, duties, trucking, everything is about $2.50 per unit. So you're making $5 and it costs you $2.50. That's a 50% gross margin. Oh, maybe you're thinking, well, that's not too bad, right? Actually, in my opinion, that is a minimum gross margin you need to hit. We have not even added your fixed costs like your team salary or warehouse or storage or office rental and etc. And the most costly thing is trade spend. The expenses you have to pay for your products to move on the shelf. To make calculations simpler, I came up with a 4 times rule. Instead of working the retail price backwards, I just take my landed cost and times 4. And then I got approximately the retail price I should be targeting. So if your landed cost is $250, like the example we talk about, you'll be pricing your product around $10. If you think $10 is too expensive for retail price in your category, then you might need to rework your landed cost or work on another product because that is an uphill battle for you. So this is a really simple rule. That rule works as a quick gut check, but it's not the whole story because it doesn't count for trade spend, which I will have a video dedicated for just that topic. Trade spend is all the money you give back to retailers and distributors as part of doing business. Off-invoice discounts, spend back promotions, new item slotting fees, manufacturer chargeback, let's see what else. Quarterly deals, end-cap display, buy one get one free, and the many ways you can spend your money to move your product. For most brands, trade spend eats up 15 to 25% of your gross sales. So sometimes more. The first year I remember I was doing business, I worked with a regional distributor, and the end of the year I realized I only got 45% of the total PO. So you have to be really careful when you say yes and when you say no, because you could have worked all year for nothing. Worse, get yourself in debt. So this is why so many founders think they're profitable and then they run out of cash. So the 4 times rule is a starting point, but you need to stress test it with real distributor terms, real retailer margins, and real trade spend before you commit to a price. So here's another question that I get all the time. So Gia, I set my MSRP at $10, but why is this retailer selling at $12.99? Well, because the retailer controls the shelf price, not you. MSRP is just a suggestion. It helps you create some sort of consistency across the store. And some retailers, they will take that in consideration when pricing your product. But again, they can also ignore it. So here is a reality. Some retailers will price you higher to protect their margin. Others will price you lower to drive traffic or compete with Amazon. So when you're setting your MSRP, go look at the shelf. Check out your competitors, see what similar products are selling for, because if you price yourself at 12 and everybody else is at 8, your product is just gonna sit there. All right, let's bring all this together and let's see how I actually price a new product. Step 1, calculate your true landed cost. Don't skip anything. Factory costs, freight, duties, trucking, warehouse fees. Add it all up. Be honest. If you are guessing, you're already in trouble. Step 2, research competitor shelf prices. Go to the store, check online, see what similar product cost. This tells you what the market will bear. Step 3, work backwards. Take that competitive shelf price, apply a 40% retail margin, apply a 20% distributor markup. What's left? That is your revenue per unit. Step 4, subtract your landed cost. The difference between your revenue and your landed cost is your gross margin. Aim for at least 50% before trade spend, because after trade spend, you're probably looking at 30 to 35%. That is before your fixed cost. Step 5, stress test it. Can you afford to run a promo and still make money? Can you handle a price increase in freight or ingredients and not go underwater? Can you take a hit from the increase in tariff and still stay in business? If the answer is no, your price is too tight. And here's the truth. If the price doesn't work, you have 3 options. Raise your price, lower your cost, or don't launch. I know that sounds harsh, yeah, but I'd rather you figure this out now than 6 months in when you're out of cash. Look, pricing is hard. It's one of the most stressful part of being a founder because it's the difference between surviving or shutting down. And if you understand those 3 layers, landed cost, distributor margin, retailer margin, and you account for trade spend, you're already ahead of most brands. Alright, that is for today's video. If you found this helpful, please hit that subscribe button. I'm putting out new videos every week on real business side of consumer packaged goods. Trade shows, brokers, pricing, packaging, all of it. Thanks for watching, and now go do your math. And make sure it works before you print that label. Also, watch this video about the 5 key players that run this industry so you get a better understanding who's taking a slice of your profit pie and why. See you in the next video.